Hey, what's up, everybody? Welcome back to Investing Sucks, and welcome back after quite a long absence. I think it's been over 3 weeks since I last made a video, and I'm finally back. I did take some time off, and I was off traveling in Peru for about a week and a half, which was an amazing trip. I definitely recommend any of you guys if you're looking for a new travel destination and you're the adventurous type to look into Peru. It was a really great trip. But anyways, I'm back now, and I'm here starting a new series, and this series is going to be called What's on My Watch List, and this is the inaugural episode of this series. And the whole point of this series is I want to spend more time on this channel showcasing my personal investing to you guys, showing you what companies I'm looking at, why I'm looking at them, why I'm interested in them, how I found them in the first place, and also what research I'm trying to do and what I'm trying to learn about the company before I actually get to a position where I'm comfortable enough to invest in them. So this series is going to help you guys potentially learn from me and also maybe criticize me if you think I'm doing something wrong or I'm missing something, and perhaps you can provide your own input, and that way I can learn from you as well, because that's also part of the reason why I want to make these videos is I want to learn from you guys as well. So like I said, this will be the inaugural episode of this series, and the company we're looking at is PRDO, which is Prodosio Education Group. I believe that's how it's pronounced. Prodosio. It is kind of a weird name, which is part of the reason why I actually somewhat liked the company, because it does have a bit of a weird name that is a little off-putting, which I think maybe there's some element of that that's causing people to look away from it. And that's kind of the new investment style I'm trying to adopt here, which is focus on companies that, for whatever reason, something to do with the business or something to do, potentially even with the name of the company, that the average person is just going to look at this company and just kind of, not really want to look at it any further and, get really off put by it, whatever the case may be. So who actually is this company? So they are primarily a online post-secondary degree granting institution. They have two main accredited institutions under their belt, which are Colorado Technical University and the American Intercontinental University System, or that's CTU and AIUS, which both provide degree programs for the master's and doctoral level, as well as associates and bachelor level. So they're really just an online school, right? They're an online university. The most popular degree they have is business management, but they have several other degrees, things like healthcare, criminology, cybersecurity. And their students are mainly older students. So 30 plus years old is their largest cohort, some coming from corporate sponsored programs, some coming from the military, some coming from government sponsored programs, and really all sorts of different students. So it's not really, it's a for-profit school is what it is, which I know some people have problems with for-profit schools, but what I'm focusing here on is just the aspect of the business itself. There are some regulatory issues, which we're going to, believe me, we'll get into that later. But for now, let's just focus on the company and actual, the number side of things, and also how this company actually came to my attention in the first place. So it initially came to my attention through a script that I created, which, by the way, if you're wondering what website I'm using here, it's a website that I created called tickernomics.com. I'll leave a link in the description of this video if you want to check it out for yourself. It's a website that's currently in the beta phase, and I'm working on developing it. And the whole point of it is to help retail investors make better investment decisions. And part of that is we have these scripts, which, you can write your own scripts. They're basically coding that can automate tasks for you guys. It can generate lists of companies, pretty much, however you want to slice things up, like whatever qualities you want to make sure that a company has, can generate a list of that. And one thing I did was I talked about this in a previous video where we were looking at what types of stocks outperform the market, and we were looking at factor investing and looking into the some of the research done by Eugene Fama and Kenneth French, where they've looked at the five-factor model. And I basically tried to create a script that pulled a list of companies that have the qualities that they discuss in the five-factor model. So if you want to find this script for yourself, you can just go to the website, and if you click on public scripts here, and then you could just search it, search FAMA French, then it'll come up here, FAMA French factor model stocks, and then it'll come here, and then all you have to do is click this button here, save to my scripts, and then you can go over to my scripts and actually run it and see what the list is. So I'll find the list here, so it's this one here. I click run, and it's going to take a few moments to initialize, but then we'll get the list. And I've used this list for a lot of companies. So there's another company that has appeared on this list that I also invested in recently called Malibu Boats, which I did a pretty long, like a 40 plus minute video on them a couple months ago, fully explaining, everything, every reason why I bought them, why I was interested in the company. And they initially came to my attention through this list. So we can see that this message here, it's done generating the list. So to access it, we go to Insight Tables, which is this here. And now we can see the list is here. So I'll blow this up a bit more so that people can see it. Right, so here's the list, and this is the table it generates, so I'll extend this a bit. And what you're going to see in this list is a lot of companies that are kind of cyclical in nature. So a lot of the same industries are going to be appearing, which the industry appears to the right of the slash that you see. So this would be the company name, like Hercules Capital, and then to the right, there's the slash. So you see a lot of asset management companies, which I think because we're looking at historical valuation metrics and asset management probably had a pretty strong 2021 year because markets did very well that year. The valuation metrics using historical financials are going to look pretty cheap, but there's a reason they're cheap, right? So what I'm ultimately looking for here and what I use this list for is I'm trying to find the industries that are kind of out of place. Like you see a lot of oil and gas, credit services, a lot of like finance type ones like banks, construction, like home construction and all that. Marine shipping is a pretty common one too, and then obviously asset management. So any one of those types of industries I'm not really interested in. It's the ones that are kind of out of place. So you can see, for example, Spin Master. I don't really know what this company is, but it's in the leisure industry. Maybe that would be interesting to look into, but I want to find companies that have pricing power because that's something that makes them unique. A lot of these companies are kind of, they're operating in commoditized industries, right? Like marine shipping, oil and gas, even some of the ones that seemed a little out of place. Once you actually like double clicked and looked into the company itself, you realized, okay, this is like a commoditized industry. It's just a much smaller one. Like if it's a company providing services to an oil and gas company, right? Because, their revenue is obviously going to be connected to them in some way. But there's a few out of place ones, and one of the out of place ones was Malibu Boats, which I'll see if I can pick them out here. There are quite a few companies in this list, so I'll scroll down and see if I can find them. But nonetheless, here's the company we're actually going to talk about today, Perdoceo. We could see them appearing here. And they are out of place because they're in the education and training space, as we've discussed, which is different than all the other ones we're seeing here. And perhaps I've already scrolled by Malibu Boats, or maybe they're no longer in this list, but they were at some point. But you get the idea, right? This is kind of how I'm using this list, and this is how they caught my attention initially. Now, another reason why Perdoceo actually kept my attention after it had initially caught my attention was because initially reading about the company, I did find it actually quite excruciatingly boring. This is not exactly an exciting company to look at. There's no super high-tech innovative product they have or, some geopolitical implication of their business that maybe you'd see with energy companies. They're very bland, they're very basic, and there's a lot of really complex issues going on with their business that kind of just make you want to look away and not touch it, which to me is intriguing, right? Because it's the exact type of company that the average investor would not enjoy looking into because, um, you know, there's just not really much interesting things about the company. And they're probably eventually going to get to a point where they're like, this isn't fun. Let me just look away. So it kind of exemplifies the new approach to investing that I said I'm trying to take, which is if I find myself really disliking learning about the company, then it's probably the type of company that I should be looking at, as weird as that is to say. So that's the first thing. But what I also liked about them is it's just an easy business to understand, right? Like it's an online education company. We can pretty much assume that the revenue is going to be tied to their enrollment. So then from there, we can think, okay, what factors are going to influence their enrollment in the future? And then you can tie that back into things like, okay, how much earnings does that mean? How much cash flow does that mean? What's the revenue going to be like, etc. And you can kind of think of a few future scenarios that this company could be in. And later on, we talk about the regulatory implications of their business. You'll realize that depending on what regulation gets enacted, then it can be pretty predictable outcomes, right? So that's another thing I liked about them. Predictable to an extent. Now, if we look at some actual financial metrics for Perdoceo, one thing I want to look at is what their return on invested capital is. So I'm going to go to the charts here and I'll pick up this metric here, MMROIC. So this is return on invested capital going back about 10 years. And we can see for the past 4 years, it's been pretty consistently high. We can see it was in the 28% here, got to up to 45% here. in early 2020. So they probably did better in 2020 because of, the lockdowns that took place. Everything moved online, but it's gone down a bit since then, and it's currently sits at 35%. Now, one barometer that I like to use to determine how good a company is at actually creating shareholder value and how good just in general their business is comparing ROIC to their cost of capital, because they pay their cost of capital to acquire capital, and then whatever they can earn on that capital is their return on invested capital. So if their return on invested capital is much higher than their cost of capital, then the company is adding shareholder value, right? They're generating income, they're generating cash flow, and they're likely a worthwhile investment, assuming it's at a decent price, if you're seeing consistently high return on invested capital. That's kind of the basic concept of this. There are other ways that you can use to kind of get an idea of the value that a company adds to society in general. For example, if you're just looking at profitability metrics like operating margin, net profit margin, gross margin, if those are much higher than their competitors, then from that you can deduce and say, okay, clearly this company is doing something unique, which is allowing them to charge those high margins if you're seeing it consistently across time. Now, this isn't exactly consistent, right? It's been consistent for 4 years, but not really consistent like you would ideally like to see if it was happening, say, 7 or 8 years. So we have to do a bit more digging and also find out why in these years back here, why it was actually negative return on invested capital, which is obviously what you don't want to see unless, the company is still kind of young, they're developing, they're just not profitable yet. So if we look at the financial statements and we're going to look at the annual income statement, we can see something that's pretty interesting, I think. So going back to 2012, their revenue was just under $1.5 billion. Now, fast forward 10 years into the future, their revenue is about half of that at under $700 million. So in 10 years, their revenue has declined by, I mean, pretty much more than half. And if we look at the trend, we can see it went down going into 2013, down again going into 2014, up slightly in 15, down again in 16, down again in 17. So that's many years of revenue declines, but since then it's been consistently growing. And what's also interesting, if we look at profit in on this higher revenue amount, $1.5 billion in 2012, they lost about $150 million versus today on the lower revenue amount of just under $700 million, they earned $110 million in profit. So what the company did was they refocused their business. They stopped investing in basically projects that weren't generating sufficient return on invested capital. They moved into different businesses that are clearly much more profitable. And this would, I would kind of have my hangups with this if it was something that just happened and you only had, say, 1 year or 2 years of history, but we have 4 years of history of the company basically just consistently growing, right? We can see their revenue from 18 through to 2021 has been consistently growing and they've been consistently profitable. So with a history like that, I feel it's safe to say that this is the new normal for this company, and ideally things will stay like this into the future if you are investing in this company. Now, another thing I liked about this company was their free cash flow generation, which is obviously a pretty important thing to like about a company because free cash flow is how you get paid back as an investor. So I'll look at the yearly view here in the financial statements and we can see what their free cash flow was like in 2021. It was $181 million, which for a company that is currently only worth let's see, a market cap of 924 million. That seems like a pretty high amount. But what you also got to consider is when we go back to the financial statements, they have $500 million. I'll go to the most recent quarterly view here. They have $523 million in investments and cash. So if you think about the company in terms of what their enterprise value is, where you take their market cap, you subtract idle investments in cash, and then you add the debt, there's actually a very significant difference between their market cap and their enterprise value because of this very high cash balance and the fact that they have basically no debt. I mean, we can look at some of their liabilities, but in terms of long-term liabilities, it's really just right here, this other long-term liabilities, which I guess this is the benefit of being primarily an online school, is you don't have to pay for expensive leases on buildings to host classes in. So that's one, I guess, competitive advantage the company has. But that was one thing I found interesting. And if I go to the charts here, I'll really show you what I mean, where I'll compare two charts. So I'm going to pull up the free cash flow, the MMFCF TTM, so free cash flow for the trailing 12 months in millions. So that's what this chart is here. And we can see it's fluctuated a lot in the past years, but really ever since 2020 or even 2019, it's been pretty strong. And then what I'm also going to enter is their enterprise value, which is just MMEV. So MMEV, and we add this in, and we can compare what these two are. Now, EV is enterprise value. Really, this is the value of their operations, right? Because like I said before, it's their market cap. You subtract idle investments, idle cash, you add the debt, which is basically zero for this company, and you get a current enterprise value of 440 million and free cash flow in the last 12 months of 138 million pretty much. So I mean, we're going to talk about the problems in the business later because obviously a company being this cheap, there's a reason why that's the case. I mean, it's not just people don't know about this company, or it's not just because it's so boring to read about that people are just missing something that's very obvious, because obviously any company that's valued this cheaply must have some serious problems with it. So we're going to talk about that later. But really, I mean, the fact that they're earning close to half, or I guess less than half, but close to half of their enterprise value in last 12 months free cash flow alone. I mean, that is extremely cheap because if they were to stay at that consistent free cash flow run rate for say just the next 5 years, I mean, you're making back your investment in the company and then some, right? Because if you think about it, if you were to buy, say, the entire company for the price it's worth right now of $924 million market cap, you get more than half of that initial investment back just by the cash and the investments that the company has in their balance sheet, right? So you make more than half your investment back just from that alone, and then you just really need the company to have a few good years of uninterrupted operations, and you've done pretty well on your investment. But obviously, there's reasons why it's this cheap, which I will talk about next. So far, this company seems like a value investor's dream, right? But of course, usually when a company is valued that cheaply, there is a catch. And for this company, the catch is regulatory risk. In fact, it's the first thing they talk about in the MD&A section of their most recent quarterly report. If we go here, we can see they got the overview section here, and then immediately after they're talking about regulatory environment and political uncertainty. And to give you a bit of background on the issues, basically this all started when the Democratic Party took office in 2020 because there was a lot of congressmen who did not like for-profit education. And them being congressmen, they have the power to basically decimate the industry overnight by enacting certain regulation or adjusting regulation. Even the slightest adjustment to an existing regulation can have pretty dire consequences on this company. And investors don't like that, right? They don't like investing in a company knowing that their stock could go basically to zero if some law gets introduced just because Congress decides that they don't like them anymore. But we're 2 years into the current US presidential term and it hasn't happened yet, right? There's been scrutiny, but it just hasn't happened yet. And the company has had 2 solid years of operations and pretty strong free cash flow generation, as we just saw. So at some point, the fear has to subside, and you have to determine what the actual risk is. And for this company in particular, I'll pull up the risk section here, but I'll kind of just give you the brief overview of what one of the major things is. I mean, really, there's a whole laundry list of potential regulations, but there's really one big one that could really change things for the company. And the risk stems from regulation that could change their participation in what's called Title IV programs, which is essentially just financial aid that's given to students by the federal government. And this is crucial because students receiving this financial aid is crucial to enrollment numbers for this company, right? Their enrollment numbers will be a lot lower if students are no longer receiving this aid versus if they were, and there are certain limitations on it. Specifically, there's something called the 90-10 rule, which states that institutions that receive more than 90% of their revenue from students that received funding through Title IV programs for 2 consecutive fiscal years then lose their eligibility to participate in the program for the 2 years following that. And that would be a massive blow to this company because they stated that 84% of their revenue for Colorado Technical University is from students receiving this type of funding, and for the other school, AIUS, it's 86%. So that's where they're currently at. So they're under, they're in compliance with the 90-10 rule, but if that 90-10 rule were to change, which is the issue, then that could, really force the company into doing something that perhaps they don't want to do, or it could damage their revenue a lot. So the rule is subject to change by expanding the definition of this 90-10 rule from just Title IV programs to all forms of federal assistance, which would include military assistance. And that would, if that were to be changed, would put them over the 90%, which wouldn't be good for them. And that's probably the biggest risk facing this company because if this rule change were to occur, it essentially limits the amount of new students that they can bring on for their enrollment numbers, which lower enrollment obviously would be bad for a company like this. But beyond this, there are several other regulatory risks that outline in the risk section. To me, this one seems like the most important. I'm still kind of in the research process of trying to learn about these various risks to see what the actual risk is and what the potential damage is to a company like this to see ultimately if their valuation being as cheap as it is justified or if the fears are overblown just because everyone thinks that because the government doesn't like for-profit education that any for-profit education company you should just avoid at all costs. So something they're doing to counteract this, they are obviously taking measures to counteract this, is they're trying to introduce more programs and trying to attract students that do not require this Title IV funding, such as students from corporate sponsored programs. But that is ultimately going to take time to develop. That's not something that they can change overnight. Okay, so the next thing I want to do is discuss the valuation of PRDO. And to discuss the valuation, I'm not going to do any discounted cash flow model or anything super complex like I've done in some past videos. I'm just going to explain the valuation just using a blank Excel sheet, which is what I have open here. Now, this valuation is going to be difficult to do because the future outcomes and pretty much how much cash flow the company can generate in the future is going to depend on what regulations do actually get enacted and at what point in time they get enacted, which we obviously don't know what that's going to be, and it's pretty hard to predict what that will be. But what's not hard to predict is what the company's cash flow would look like under those scenarios. I mean, you can really kind of assume what they would be given what regulation gets enacted. But the problem is you just don't know what regulations can get enacted. So obviously, no investment is without risk, and this company certainly does have quite a bit of risk, which is why it's valued so cheaply. But let's start just by simply putting in the price of the company. And say you were to buy the whole company. So it's currently worth $924 million. Now, as soon as you buy the company, you get back about $500 million in value because that is the combined value of the investments the company has and the cash they have on their balance sheet. So it wasn't exactly 500 million, but we can pretty much just call it that. So investments in cash, we'll say 500 million. It's around that number. So the enterprise value, or EV, is going to be price minus that. So this is the value that you need to make up for your investment through the actual future operations of the business and their future cash flow generating ability, we can call it. Now, let's say a pretty good scenario for this company would be 5 years of uninterrupted operations. So there's no major regulations that get enacted. Congress pretty much leaves them alone. They don't significantly change anything related to their Title IV funding, and they can basically have years similar to last year for the next 5 years. And, the size of their school doesn't grow significantly, it doesn't decline significantly. Things just kind of stay the same. So let's say 5 years of $150 million in free cash flow. So under this hypothetical scenario, what is the value that we're getting for the investment? Is it worth it in this scenario? Because one thing we can deduce is if it's not worth it in a scenario where things basically stay the same for the next 5 years, which would be a pretty favorable scenario for this company based on what I can tell. If from this alone things aren't looking good, then it's probably best to just avoid this company and move on. So to do this, I'll use the NPV function, and I'm basically going to calculate the net present value discounted at 10%, so 0.1 of this stream of cash flows here. So we get $568 million. So in essence, we're paying $568 million or we're paying $424 million for $568 million of value, which is a pretty good deal, right? But we can also change what these are and play with it a little bit. Like let's say it's not 150 million, it's 100 million. and let's extend that out. Now it's not really worth it, right? And 100 million isn't actually terrible considering, what we've seen from this company. If we go back to the financial statements, we'll look at their cash flow statement on the annual basis. I mean, there's even some years like 2018 and 2019 where it was lower than this. But let's say in these 2 years, like 2020 and 2021, it was actually higher than 150 million. It was 171 million, 181 million. I mean, those are pretty favorable scenarios in my opinion for this company. So if they could have 5 years of uninterrupted operations similar to the past 2 years, then that would be a favorable outcome. But obviously, there's risk, right? That's not guaranteed to happen. It's possible that there are those changes to the 90-10 rule that we discussed, but there are certain things the company can do to kind of mitigate those effects. So, for example, they are allowed to be in violation of the 90-10 rule for up to 1 year, which would give them 1 year of strong operations, and they could potentially make an acquisition of a similar for-profit education company that has a high student population that does not rely on Title IV funding, and that can help them get their ratio back on side. So they're basically in violation of the 90-10 rule for 1 year. They use the cash that they generate from that 1 year in operations to purchase a company that gets them back on side the ratio in year two. And then things are good and they can basically continue operating. So that is one move that I could foreseeably see this company doing. And management has shown an appetite in the past of making somewhat large acquisitions. So I definitely don't think that a pretty significant acquisition kind of like that one I just described, is a move that they have on their chessboard. But there's lots of future outcomes. And personally, I have not invested anything into this company yet. This is definitely one where part of your due diligence has to be reading the entire risk section. And I think because it is so opaque with so many threatening regulations to this company that I think if you are willing to put the work in with this company, there's a good chance that opportunity exists. So, I mean, I'm curious to see what ends up happening, and I will be following this company going forward. But as for now, I haven't invested anything. But anyways, guys, I hope you did enjoy this video and you found it insightful. If you did, then please leave a like. And if you're new to my channel, I'd appreciate it if you would consider subscribing. And I'll see you guys in the next video.